terms of profit. So we shall do a bit of financial analysis to check the financial ratios. We shall not do this moving up, but I can just mention a thing or two. So DCF is a way of evaluating a company. If we want to determine the value of your company, there are three ways. I can do the market approach, where I look at the value of similar business in the company and look at the ratios and compute the value of a business using the market approach. DCF is what we call discount cash flow. So discount cash flow is we look at your current, how much you are making vis-a-vis your projected expected revenue and use it to determine the value of the company. And that is what sometimes is used to negotiate with the investors. So that is the discount cash flow model. And some people call it the income approach. So I've mentioned the market approach. Then there is the income approach, which some call the discount cash flow model. Then we have the cost approach. The cost approach is what you see. I think you've come across the cost approach because it seems to be quite common, where I have land I'm selling, okay? So people just come and say the value of this business, you have machine, you have land, you have what? That is it. That is the value, okay? But you see, there are some things you cannot typically determine by value, like Zoom, for example, this Zoom that we are using. What is the value of Zoom? You cannot touch it, you cannot see it, but it is more valuable than even an airline company. How do you determine the value? We use such methodologies like discount cash flow, Jumia, okay? It is just a software, it just facilitates access, e-commerce. How do you determine the value? They may not have any assets, safe border, they have no borders, but they are very valuable. How do you determine? Are we together? So the cost approach is mostly used for when you determine the replacement cost of an asset. So if I want to sell, okay, usually what is the value, the replacement cost? So there are three ways in which we value, the cost approach, the income approach, and the market approach. But those ones, usually it's a bit advanced. I don't want to go there. Then M&A is mergers and acquisition model. For example, it's not common so much in Africa because we are not open to that kind of opportunities. But sometimes I can find Edwin has potential to expand in the entire country. But instead of him expanding, I can say Magezi is already in Mbarara. Why don't I combine Magezi and Edwin and have one company? They can operate independently, but they're under one umbrella. That is what we call mergers and acquisition. So a company can say, we're going to invest 500 million, and yeah, that should allow us to have both companies together as mergers. But that gives a stronger brand, okay? So you'll find that exists so much in Europe. When a company wants to go either in a new market or want to invest in a new product, like Facebook can decide, I want to buy Instagram, I want to buy WhatsApp, the way they did, it was a merger and acquisition. Okay, they get any potential competitor that they feel can add more value to the company. Okay, scenario analysis is, or scenarios is, financial models can be worked on in terms of even explaining what is the best case, the standard case, the worst case. So, but we are not going to go there, but it's something that can be worked on, where a business can say, okay, best case, these are the numbers. Standard case, these are the numbers. Worst case, these are the numbers. So that it is a basis of discussion. Sensitivity is more of depending on change. Depending on change, how does the business behave? But as I say, these models are ahead, but just for your information, you know, sometimes it's just good to know the basics of this. Okay, so we shall pay a lot of attention on our three statements. Okay, all right. If there's any question based on what I've mentioned, feel free to type or ask. Okay, so the three statements which you know: income statement, balance sheet, cash flow statement. And we're going to sort of tie them so that they are sort of related. Okay. All right. What are the steps? What are the steps we are going to use? The steps are 4. 1, we are going to build the income statement. Okay, we shall build the income statement, but in the process of building the income statement, just like the template you saw, we didn't have depreciation and interest. Okay, so when we build the income statement, we shall leave depreciation and interest and go and work on it somewhere else on a working schedule. Then we shall also determine our capital expenditure and our depreciation schedules. Okay, schedules are simply the cost we expect to incur. And then step 3, we shall build the balance sheet and put the historicals based on the capital expenditure. And then we can tie that to the cash flow and finish the balance sheet. Ideally, these are the 4 steps. It can be long, it can be short. It's good to know the steps just as basic, because sometimes I don't want to be a bit complicated. So these steps are what we are going to use. Let me see, anything else? Okay, this is equally an illustration of the steps. We shall do our computation up to EBITDA, earnings before interest, taxes, depreciation, amortization, then determine the accounts receivables, the inventory, accounts payables. We can also determine the deferred revenue, which is a liability. Then we shall do PP's property and equipment, then the capital structure. When you determine those numbers, you can bring them back into the income statement, the balance sheet, and the cash flow, and you finish. Now, for this to happen, ladies and gentlemen, it necessitates using a different worksheet. So I'm going to try and work on this worksheet. I have not shared this worksheet because I've spent some time trying to see, okay, how best should I share before, or should I take you through, then you try it on your own? So I thought it's best, like, you see the different dimensions, then I can share, because that will allow you to at least be more acquainted. So let me see if I can. I was trying to play around with some numbers. Let me see. Okay. Maybe for purposes of everybody, if you don't have a pen or blank sheet, please get one. It would be good to just mark a few things here and there that you will find necessary or good for you to remember. Other than that, I'm just going to proceed. And at the same time, feel free to interrupt me if you feel if you have any question that you would like me to answer. Let me just confirm that I have this open. Oh, right, I have it open. Okay, so I'm going to just show what it's called, draft. Okay. Okay. Okay, so I was working on a draft template. So as I said, 1, you have the option of the financial statement I already shared. If you fill in, it still works. Okay, it still works. But here I'm just trying to advance a little bit because the statement I shared did not have working schedules. So it made it a bit complicated to have a complete thing. So before I start, this is a draft. So I'm going to use one of your companies. Let me see. For Mr. Ariko, is the Quality Solar Enterprises, if I recall. So I'm going to feel free to ask any question as I proceed. Quality Solar Enterprises. Okay, I'll share this later. I'm just using this as an example. In fact, let me just save it as an example. Example draft. For example. Okay. Okay, Quality Solar Enterprises. I don't know the email. I'll say Quality. I'm just going to use Quality. What is it? Quality Solar. Quality. Mr. Rico, forgive me if the email is not correct. I'm just using qualitysolar@gmail.com. Then I'll say phone, maybe plus, I'll guess. Maybe we have a lot of it. You can just can say www.qualitysolar.com. If it is there, you put. If it's not there, so what do we deal in? We deal in electronics, solar products, and equipment. I don't know. Okay. Installation and maintenance. Interrupt if you have any question. I'm just working on something that I'll share with you. So ideally, this is going to be a model. Okay, so that is done. I've done the cover page. Isn't it looking amazing already? Okay, so that is the cover page. Okay. Sorry. Okay. All right. So that is how the cover page looks. That is one of the differences from the previous template. But yeah, that's cover page. It's basic. Okay. Now, ideally, I should just have the basics. But I realized that for our case in particular, you may need to put your variable cost separate. And so I decided, okay, we can actually look at the variable costs. I'm going to remove these ones, the capital costs, because that one we are going to capture that in our depreciation schedule. Okay, so production costs, maybe the wholly I'll buy raw material, packaging, labels, direct labor. Okay. Power, transportation, whatever is involved in you producing. So that can be your total. Okay. I'm just assuming. And then maybe, I wish I could use Mr. Rico's example. Let me just assume, okay, for purposes and the interest of everybody, I'll just leave it as this raw material, because some of you, if I use tank as a raw material, somebody may think it's an asset, but it could be a raw material for his product. Okay, so I'll assume these raw materials make 10,000. Let me separate this. Okay, make 1 million products. Okay, so anything in blue you can change. By the way, as a matter of principle, in this document, anything in blue you can change, anything in black is by formula. So you should not change anything in black, because you will distort any hind formulas. Okay, so anything in blue. So ideally, raw material, I know how much. Packaging, if you don't have that as a cost, you just put 0. Okay, and how many products? Maybe this 1,000 kilos or 1,000 kg or whatever. So the total cost vis-a-vis the number of products allows us to determine the cost of making each product. So automatically, the moment I put the total products, it will compute for me 262.2 as the cost of making the product. Okay. Now, this comes automatic. So you don't need, as long as you calculate your cost of production and you put the number of products, it will determine the cost of making each product. Now, you can add the cost of selling each unit of a product. Now, that one is for you to determine, okay? And that will allow us to determine the cost of a product. So I'm assuming you make briquettes. For me to make 1,000,000 kilograms, I will spend 262,200,000. So that means the cost of making each kilo is 262. Maybe for me to sell and distribute, it will cost me another 200 shillings to distribute each kilo. So 208. So I'll add the 208. It could be less, it could be more. So that gives me the total cost of the product. So when I know this cost of the product, it can help me determine the selling price of my product. Okay, I'm going to delete this. Okay, I'm using some basic thoughts for us when we are looking at determining costs, because that is going to determine our, when I work with the first model. Okay, I'm going to show you one version and another. So the first version, I'm going to use unit economics or unit costs. Okay, I want to know what is the unit cost per, what is the unit cost of selling, what is the unit price, what is the price. Okay, and this is a precursor of what we did when we were doing break even. Okay, so when I know the unit costs, okay, on this tab called unit costs, I'm assuming I have 3 different products. Okay, so if you have 3 different, maybe you have stick, maybe you have honeycomb, you already know the variable cost, because the variable cost can be determined. In this particular case, it's 262. In this particular case, it can be 262. Okay, so I'm assuming you may have different products. So you can say, I'm going to again calculate another. You can calculate other production costs for each of the other products. Are we on the same page? So I can just copy this and create another. Okay, and create another, and I'll say amount. Okay, sorry, I can as well just copy the entire thing instead. Okay, I'm just going to copy the entire thing. So I'll assume this is production cost of product A. Okay, for those who have other products, I'm just assuming. Okay, I can just copy this cost and okay, undo, I'll paste. I want to paste the okay, I want to keep everything in terms of the formulas and everything. So I can copy that and say, okay, this one is product B. And I do the same. I put the numbers. I can say this one is 500. Okay. Okay, for those, if it does not show the formula, you can look here. There was a formula here. B3, which is this times this is equals to this. So I'm just going to repeat the same. I'll say it's this times this. Okay, and I'll just drag down. Okay, in Excel, when you drag, it just brings everything back into shape. Okay. Yeah. So it has just, so I can change the figures now. 400. I can put 15. I can put 12. I can put 4. Okay. I can put maybe 900. Okay. Okay. The sum, as you can see, the sum was this. So I'll just still do the same. This to this. Okay. I wouldn't want us to worry about the formulas. As long as you are able to put the figures, we shall still be able to guide you on how to represent this. What I want you to know is the principle of determining the unit cost of your product, okay? And yeah, this was an example, okay? I'm going to delete this, but I hope we've seen how we can determine maybe the unit cost of various products. Now, for some of you who have several products, you remember we calculated break even and we're calculating, okay, how can I find one price for the several products I do, okay? So in some cases, since we did this, the formula is just there now, okay? All you need to determine is the price, where you just put the price of whichever product you do. And then, so for example, I may be doing stoves and I say, the first stove is 25,000, the second stove is 15,000. The third stove is maybe 12,000. Okay, I don't have a fourth product, I'll put 0. Okay, and I say, this contributes 30% of my revenue. I mean, sorry, I have to determine the amount it contributes to my revenue for me to. So I'll say I sold 50, I sold 80, I sold 50 still. Okay. You realize, as long as I put the quantity and the price, it already gives me the weighted price. Like, even if I'm selling 3 stoves, the average price of your product is 18.58. So that has already been done. Remember, we were trying to calculate break even at some point. So this already covers that for you. And at the same time, since we've already learned how to calculate the variable cost per unit, all here, if I'm selling product A at 25, maybe my cost per unit is 18,000. And then here I'll put, maybe I spent 9,500 on this. And then here I spend maybe 7,500 on this. Okay. Just with that, I'll also know the weighted unit cost. I'm already just covering what we covered, but with already pre-inscribed formulas. Okay, and they are only for people who have different or more than one type of product. But if you have one product, that means you have one price and one variable unit cost. So you don't need to. But I have placed this. Usually we don't put this because the assumption is you already have calculated, but this is just to support. Okay, so now we are now going to one of the financial models. There's version 1 and version 2. Version 1 is basis on mainly unit costs. Unit costs, it just looks at things by virtue of what is the unit cost of this, what is the unit cost, then how many did I sell? And based on that, we can calculate your profits, your profit and the other costs. So the first version is purely based on unit costs. Now, the assumption is you know the units, you know the cost of each unit. So for example, I'm assuming in 2018, so first and foremost, I'm going to follow the same rule. Let me go back and show you the rules that we said when we are making our financial statements. Let me just go back. We're going to follow the 3 steps, and the 3 steps are as you see below. Let me repeat the process I'm going to take, sorry. These are the steps I'm going to take. 1, build the income statement, leave depreciation and interest blank. That is number 1. the first thing we're going to do. Then after that, we are going to calculate the capital expenditure, which will allow us determine the depreciation. We shall also look at the financials. If we plan to borrow or we borrowed, then we shall factor that. Now and then we shall also determine the working capital schedule. So in terms of at the end of the year, do we normally have everybody who have paid, or there are some people who delay? So naturally at the end of the year, there'll be some money pending and there'll be some money I'm also owing people. Okay, once we compute that, we shall fix our income statement and our balance sheet and our cash flow. I hope just using this, you will see how it flows, okay? But the most important thing is just understanding the steps. The income statement, then we shall do the other schedules, which in the first original template, there was no provision of that. And that's why I thought, let's use a different approach. Okay, let me go right ahead. And feel free to ask any question. If you feel I've left you behind or you have a particular question, feel free to ask. Okay, so as you can see, my Excel looks, I've tried to format it so that it looks nice. As you can see, 2018 historical results, then projections. Historical results means you already have the numbers. Okay, projections means you are going to project ahead. So you are going to put some numbers. You may not have the numbers now, but you are projecting, because when you intend to engage financials or banks for money, usually they say, okay, how much do you expect to perform? Obviously, you put your projections, which is supposed to justify if you are worth being given money or not. Okay, so usually we have historical results and projections. Okay, remember, investors look at your past, financials look at your past, then invest in your future. Okay, and that's why the historical results and then projections help. Okay, because you cannot say this how we are performing and then suddenly things will just happen out of the moon. Usually there are some factors which come into play. Okay, and that is why financial models help. Okay, so key a financial well, it's a financial statement, but in a model format. We usually have what we call assumptions. What are assumptions? Assumptions are now that is where English comes into play. What is an assumption? An assumption is what I assume. I will assume maybe things will be okay. I will assume maybe I will make this money. I will assume maybe I will spend this on A or B or C. Or I will assume I will get this money and do ABC. So an assumption is what we presume before. It's like we assume before it happens, or plan before. So many times here they tend to be black. Purposely, because I did have some numbers to experiment with, but we are going to try and experiment the numbers together. Okay, so one, we normally have assumptions, and we have two kinds. We normally even can go far and say, okay, sorry, let me remove the color here. Okay, so we normally say assumptions for income statement. So these are assumptions we normally put, and then we can put assumptions for balance sheet, okay, below, as you can see. And I think I mentioned about accounts receivable, inventory days, all these were terms we came across, okay? So here it's just trying to implement what we already know. As I said, this first version of the statement is looking at units, just making use of units. The second one will not based on units. It will based on a typical performance. So you will gauge based on how your product works. Would you prefer working on units, or would you prefer just working holistically? Like we shall make 500, next we shall make 1 million. just like the statement that you saw. Okay, so I just wanted to have both options available for you to determine. I'm seeing statement. Why is direct labor included among variable costs while salaries are left out? Direct labor is increases. We just to take us back, when we defined variable costs, these are costs that increase with increase in production and reduce with reduction in production. So naturally, direct labor increases productivity. Okay, and that's why it is under variable cost. Salaries are operational expenses because they are not direct to, they do not influence productivity. Okay, so it becomes an operational expense. Can one combine more than one product line in the same business plan and financial plan? The answer is yes. The answer is yes. Now, let me also try and answer. The answer is yes, and you can actually put different products. But as you can see, I was trying to reduce the complexity. Now, financial models are not meant to have to look like a typical. I'm trying to explain this. Financial models are very simple. The thing is, most of the people you are likely to engage outside are not sort of experts in what you do. They just want to understand the numbers and how they flow. But also, not all entrepreneurs are counting based. So you don't want to, okay, we did 40, this. You want to see the key attributes that either influence the business in this or that. So you'll find one of the reasons why I did some calculations or computations in other tabs was to try and compact. I was trying to compress all this into sort of units that I can use in the financial model. Okay. If somebody prefers to put everything, we still have the other original template, which when you do your working schedules, you can still make use of that. I just want all of you to have that dynamism in terms of what you can make use of. But from the initial statement, you could find all the products were there. You could put product 1, product 2, product 3, product 4. But you can still combine product 1, product 2, product 3, product 4, and make a weighted price and a weighted cost, and now work on financial template of 1, the first version. Now, how does it flow, ladies and gentlemen? This one is, I looked at it, and it flows based on just a very basic thought process. 1, we ask you, in that year, how many customers do you expect? Remember, we did our business plans, our business models, and developed our plans. And in it, we looked at our markets, our target market. I target 300, I target 400. By the end of the year, I target 500. So here is where you put the number. I say, okay, in year 1, I target 200, year 2, I'll do 300, year 3, I target 500. Now, I still want to emphasize, these historical results, I'm assuming you already have. In future is when we project. So usually, this is always in black because we already have the numbers direct on our income statement. So usually our income statement is already there. Okay? Usually the income statement is already there. But for purposes of our case, I'm going to assume maybe some of us do not have because maybe you didn't have the records or what have you. I will assume the life of a customer is 1 year. Life, not how long they live. It is how long they stay committed before I have to again engage them. So I'll assume for a year, they can remain committed in buying my product. That's the only other assumption I'll make. Then, how frequent do they have to buy? Okay, how frequent? Okay, are you following how I'm answering these assumptions? Number 1, target number of customers. I can say in 2018 I did 200, I think. 2019, I did 300, 2020, maybe COVID affected me, I did 350. 2021, I shot 500. 2022, I think we shall do 700. 2023, I think we shall do 900. 2024, I think we shall do 1,000. 2025, maybe we shall do 2,000. Okay, you know your numbers, whether it is in kilos or in tons, you know. I'll leave the life of customers one. The assumption is at least a year. It could be less, it could be more, but for most of us who are doing physical products, I'll assume a year. Was that commitment? For junior, I may put 4 years, okay? Because with the technology is a bit trendy. Life of product means how long does he use for him to come back? So in other words, in 1 year, how many times will he buy from me? That is the answer I need. How many times? Will he buy daily? Will he buy monthly? Will he buy once in a year? So in this case, I'm going to assume he will buy once every month. So if he will buy once every month, I'll put 1 out of 12. I want to emphasize life of product is how frequent will he buy? How frequent? Is it weekly, monthly, annually, daily? If it is once in a day, I'll put 1 over 365 because there are 365 days in a year. But if it is once a year, I'll put 1 out of 12. If it is 4 times a year, I'll put 4 out of 12. Okay. So you know how many times it's 4 out of. So I'm going to assume, okay, let me say 4 out of 12. That means he buys at least 3 times. So I will extend this. Okay. So are we seeing? So when I say he buys 4 times a year, it means if he buys 4 times a year, it means after every 3 months they buy. After every 3 months. So it means every 3 months they buy. So this is actually 3, I'm sorry. So that comes to 4 because it's 4 times a year. Okay. So that it's 0.25. Okay. I'll extrapolate. To extrapolate, you just copy the formula and copy in the other cells and it will just come. Okay, the other question I need to ask. As you can see, this is in black, so I'm not going to touch that. It's based on a formula, so I've already computed. Now, the other question is, when they come to buy, how many kilos do they buy? On average, some buy 5, some, okay? So I'll assume every time he comes to buy, they buy 5 kilos. Okay? Every time they come to buy, they buy 5. So I'll put 5, okay, and extend that. Ladies and gentlemen, I hope you can see how simple this we're trying to make this. Okay, so as long as you answer those questions, okay, so what is the cost I spend to get each customer? Since I'm saying I'm going to get 200 customers, how much do I spend to get 1 customer? Maybe I have to spend 10,000 to get 1 customer. Then I'll put 10,000. Okay, that is an assumption, and I'll put that. Okay, that is the cost of acquisition or the cost of getting 1 customer. Okay, as long as you've answered that question, the rest it's just computing on the background, ladies and gentlemen. Okay, cost of making. I think I already showed us the cost of making. You just put the raw materials. Okay, you combine the raw materials, the labor, even if you pay yourself or you, that is part of the cost. And we already calculated that here, the cost of making. Are we seeing? So depending on the product you're making, this is the figure that I want you to bring here. Okay, so I'm going to assume the cost of making this product is this figure 262. So I'll say 262. I spent 262 to make this product. Okay, and I will extend this. If it changes over the years, you can still change the cost. Okay. As I said, anything in blue, it's up to you. You can change. Anything in black, allow the formulas to do their work. Okay. So that means if I spend 500 to sell the product and I spend 262 to make the product, that means the cost of each product is 762. That is given already derived by the formula. So you don't need to worry. Okay. Now, since I already said that each time a customer comes, he buys 5 kilos and I'm getting 200 customers, it already, you've seen the formula already tells you that I will sell 4,000 products that year. Okay, so all I need to feed here is what is the price of your product? How much are you selling each kilo? I'll say, like Mr. Gundi, Edwin says 1,500 a kilo. Or I can say maybe I'm selling in bags. So maybe I'm selling a bag of unit, say 15,000. Okay, I can say that. Okay, that is the price per unit. Now, as I said, as you can see, I'm just filling anything in blue. Anything in black, don't worry, the formulas will do their work. So basically, I've computed, and by just doing this, I've already done our income statement. Okay, I've already done our income statement. You want to see? For purposes of okay, on this side, you can see it has already computed. On this side, usually the assumption is since you did it, since you have you already operated, the numbers are there. But if I am to use what I've just used, I will drag this backwards. Okay, and everything will be there, as you can see. It will mean in 2018 I'll make 60 million. 2021 I'll make, also I've not put the cost of goods sold. I'll drag back again. Sorry. Are you seeing everything is there? And the formulas I've already given you. So based on this template, you can see your gross profit, your gross margin is clearly here. You are making 95%. It's already computing for you. Okay. Okay. On operational expenses, that one you have to make an assumption. So I'm just going to define that. If there are any questions so far, feel free to ask. As I said, as long as you feed in the assumptions, the income statement will be completed for you naturally with the formulas already attached. Okay. Okay. Okay, so I have calculated this, but based on our based on our model here, the assumption is I already have for year 1, 2018, 2019, 2020, I have an idea what my operational expenses, that is salaries, rent. So I'm just going to assume here I have some figures. I say, sorry, I'm going to put here, let me first change the numbering. So I'll put here, maybe in the whole year, I'll spend 15 million on operations. Okay. This 15 million. Allow me to just change to Uganda to GDS. Okay. Right. Okay. And I'm just going to extend this. So ideally, I'm making it possible for you to just type. Okay. Initially, it was doing more of percentages, but I want it to be very simple for everybody. Okay, so this is 15 million. It can change to maybe 18 million. It can change to 20. Okay, you know your business better. all I'm doing is just putting the model out there, and for you, you can just compute. So with this, I will just come here and since it is already up there in the assumptions, I'll just pick this, okay? And you'll see it appears here, and the rest is history because it's going to be computed, okay? So whatever I put up there will come down here. So I'm just going to make this as a formula, so nobody, as long as you put it on the assumption side, your income statement is basically done. So you'll find you now have your EBITDA. For those who needed to do EBITDA. Now, I want us to know how we can calculate our depreciation. So I'm going to take us to the working schedule. And these are the things that were not now in the other statement. So I'm just going to delete this so that I'm going to start it afresh so that everybody understands this. Okay. I've removed the depreciation. What else? Okay. I'm also going to remove financial expense for now. Okay, for now. Okay, so that you see how it comes. So you can see the income statement based on our process. Step one, just fill in the assumptions and your income statement. Up to here is complete. Up to here, your profit and loss is complete. Okay, now, for us to be able to compute depreciation, which we don't have, we have to see what assets do we have as a company? Do we have machines? Do we have vehicles? Do we have tools? Do we have an infrastructure, maybe a building? How much are they worth? Okay, so that we put and attach depreciation. Are we together? So there are ways in which you can compute. There is the typical calculation, which I'm also going to show, but there is where we sometimes simplify if you have the numbers already. Okay, so we all come from different dimensions. There are those of us who already have accountants who already computed for us. Usually it is easier that way because here we feed in and make projections. But for those ones who don't have, it's a bit of a journey, but let me try and show you on this tab. Just for those who don't have, so that it's clear, so that you can know. Here is where you work. This is how you can calculate the depreciation schedule. But it's usually a bit tiresome, but I just want us to know, because on financial models, we try and simplify. Oh, there's a question here. When making projections in the income statement, is it necessary to consult our historical records or just base our judgments on the assumptions? Ideally, the assumptions are supposed to be based on the historicals. That is why many times, okay, just before, I want to answer Musa with another example. That is why you will see this is a standard, I'm just going to show a standard financial statement here, standard financial model. Okay, so as you can see, Musa, if you can look here, these are historical results, okay? Now, because are you seeing it's in color black? The reason is they're in color black because down here in our statements, they're in blue, meaning we had the figures. So it computes the assumptions, okay? So if we have the numbers, we can compute the assumptions. Now, using the assumptions of history, we can project ahead, now in blue. Are we together? Ideally, that is the case. Okay, so the assumption is historically when we have the numbers, you just feed in the revenue, the income statement, everything. Now, using this, on the assumptions, we can calculate, okay, how was the revenue increasing? How was the cost of goods as a percentage? Salaries, what range, rent, overheads. So using that, when we go in the years ahead, we can easily project or develop more qualifying assumptions. Are we together? The assumptions will be more qualifying. But if we don't have historicals, then naturally we have to project from the word go. Are we together? So that is or we even sometimes have to make the assumptions from the word go. But if we have these numbers, and usually if you have accountants who give you your financial report, ideally you should feed, and that whatever you feed on the income statement feeds our assumptions and helps us determine the assumptions that we are going to determine in the future. So ideally, as you can see, the assumptions can be computed from the historical already derived numbers, and then we project the assumptions and now derive the numbers of the statement. Ideally, that is how it should flow. I don't know if I've answered you, sir. Okay. So in this version, I just assumed some of us do not have, and I wanted something basic that we could use. Whether you want to work with the assumptions or you have the numbers, you put, and then when you have the numbers and you put, then we can use the next projections to actually determine the others. Either way, I just wanted something flexible that the people can use. Please feel free to ask, and I hope I've answered you, Musa. You can just confirm if it is clear. All right. People are not speaking today. I don't know. I hope I've not sunk anybody. All right. So let's look at how a typical schedule looks like. A typical schedule. Oh, yes. Yeah, there we were. So for those ones who want to compute depreciation from a realistic perspective, you will put your, I have a crusher, I have a compactor, I have a mixer, I have computers, I have software. How long does it last? I say, the crusher will last 4 years, I'll put. The compactor will last 4 years, I put. The mixer 4 years. Computers maybe 3 years. The software maybe 3 years. Okay. How much do I buy it? Maybe I bought the software at 500. Okay. Okay. So first of all, the year when you bought them comes here. Okay. So when you say useful life means how long will it be useful before you need to sell it, maybe as a scrap or something. Okay. I'll put the useful life of each of these. Now, ladies and gentlemen, we are going to calculate depreciation. Okay. But sometimes it's okay. I don't like this one because it's a bit heavy in terms of calculation and some people get lost. But for purposes of just us knowing, because with financial models, we just use, we calculate the total number of, the total capex and look at the depreciation as a percentage, and that is simple. But for the interest of everybody, I like just bringing 2 dimensions. So this, let me see, one, put a border here, a nice border. Okay, then we calculate here what's the total. The total that is this one to here. Ladies, don't worry, you don't need to know the formulas, you just feed in. All you need is to feed in. Okay. I'll put this in blue because you are feeding most of this time. Just don't forget anything in blue, you can change anything in black, don't change its formula based. Okay. I don't know if this is a question. When making projections, I think I answered that. Okay, thank you. Okay, so we normally buy machines, and some of you intend to buy machines. Okay, let me assume we're in 2021, ladies and gentlemen. 2021. But I wanted to accommodate those ones where you've seen it changes the years automatically because we've already put those formula. Okay. Assuming with Repi, we have bought the crusher. This is the duration it will last. Okay. Maybe in 2024, I'll buy like 4 more machines. You know better how you plan the use of your, okay. Here, we just compute the assets that you bought or that you spend on or that you bought. I don't know if that makes sense. Yeah, so these are the costs. Let me see if there's another cost. You can help me if you want another cost here. Say I'll buy another here. Okay, so as you can see, this is total capital expenditure. When you see capex, it means capital expenditure. Okay, and depreciation is now computed using that. Don't worry, the formula is behind. Just you to put the figure. So a crusher is my crusher. It is here. So the depreciation is this divided by the useful life, and it repeats until the useful life is done. Okay, so if it lasts 4 years, maybe I'll add another. I just want so that it does not sound like I'm forcing some numbers here. Okay, so here I do, that is the depreciation. Year 2, the same. Year 3, I have to add, because it's this depreciation plus, so I have to put this in brackets. Don't worry about the formulas, I'm just trying to derive. The formulas are our problem. Your problem is just to know your numbers, that's all. This pick 4 years, sorry. The same. Oh, what is the, where is that? Okay. It will be this plus this. The problem with the formula, sorry, I don't want to repeat. Let me just okay. So I'm supposed to add that's 200. It has to be specific. 200. Divided by the useful life. Okay. Yeah. So I'll just keep on adding. So this, yeah. Sorry. Hold on a second. I had to move this. Keep it locked. Okay. Yeah. That is okay. Yeah. Okay. You don't need to know the formula, but if you're interested, that is also something we can discuss. I'm just computing the depreciation. Okay, here the same. It's equal to this. Sorry, I have to lock it. This. Sorry. This divided by this, but I have to lock them so that the number remains the same because the depreciation figure is the same. Okay, so that becomes our depreciation. It continues until we find ourselves in this other year where we have to add. So I'll just pick this. I'll just pick this and say plus the same. I bought another machine. So since I bought another machine, I have to add that the machine. E5. I hope you are seeing some of these formulas that are behind. By this. Yeah. Okay, so that means, yeah, that will be the depreciation for the other years. Okay. What else? Okay, mixer. I bought in 2 concurrent years. That will be this divided by this. But usually we have to lock so that the figure does not, with the Excel, when you pass it, picks lock it. Sorry. Lock it. Okay. Yeah. But for this year, I have to add this other because I bought another machine. Divide by the same. 4, sorry, divide by this. But I have to lock. Okay. Okay. So the depreciation of the years is coming. As I said, this is usually a bit tiresome, but I just want us to know before we see the other options available. This is this, obviously divided by the lifetime, the useful life. Same. That. And that. Okay. And I will extrapolate the same of x. Okay. Remember, if it is 3 years, by the 3rd year, the value is 0. So I need to remove for the years that it lasts. Okay. Yeah. Same to the others. For example, this one last year 1, year 2, year 3. So year 4. Yeah. Yeah. So this gives you an idea of depreciation, just for the interest of us to know. But as I said, we don't like taking the entrepreneurs through this. It's for the accountants to go through this. So we don't like approaching it from that angle. But for the interest of knowing, and for knowing just how we can compute the depreciation, that is what we can do. Sorry, where is this? So we put a line. Any questions on depreciation, ladies and gentlemen? I just wanted to share this, though I also don't enjoy it on that one, but for purposes of knowing how you can use the long cut. Okay, we have the long cut because in financial models we don't go for the exact, because usually you still in finance you not see exact, but you will we usually make those assumptions and projections. Okay. All right. Let me just confirm that I have looked at the useful life for all of them. This is 1, 2, 3. Yeah. So this one will actually be 25. I'll now need to remove this. Okay. Yeah. So as you can see, that is why I wouldn't want to put you through that process, but for the interest of knowing, so yeah, so this one will be, yeah, because this useful life is 4 years, so 1, 2, 3, 4. So on the 5th year, the value goes less. Okay, then this one, 4 years. So it will, on the 4th year, yeah, it should actually, we should actually add during this year, should add another. This, yeah, should do this divide by the same. Okay. 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 I'm going through this so that when I show you the other alternative, you can all opt for the alternative. Yeah. So then one, then on this year, one, yeah. All right. So yeah. Anything else? Anything else? Yeah. Seems clear. Sorry. This is we didn't use this. We have to capture. Plus, we bought another equipment, and we have to capture that here. And you have to lock it, and lock it, and lock here, and lock here. For those who don't know, the formula of depreciation is just basically that over the useful life. So when I get these numbers, I've calculated the depreciation, which I can now take back. I can now pick this and bring it back to my depreciation here and amortization. Are we together? So we normally calculate the depreciation somewhere and then bring it back to the income statement. But the same depreciation also contributes towards, remember, we have now done two things on this sheet. One of the things we have assessed is the capital, and then the depreciation. Okay. Okay. Now the other bit, and that's why sometimes this is a bit, it's a bit strenuous. But once I've calculated depreciation, I should also be able to determine what is the total capital at the end, closing property and equipment, or closing capital, or closing assets by end of the year. So I still need to calculate. Now the challenge is, because I need these details for the balance sheet. Okay, so when you go through this, some of you may start and give up along the way because it sounds a bit frustrating. Okay, but what alternative can you use? Let's look at our model, and this is the other alternative you can use. And I'm going to just spend a bit of time to explain the depreciation and then calculating the working schedules for purposes of all of us understanding this. I want us to understand the working schedules. So because I want us to understand the working schedules, I'm going to ask us to take a short 5 minutes break so that I spend a bit of time on explaining the working schedules, because once you understand the working schedules, the balance sheet, the cash flow will be easier. But I want to spend a bit of time and explaining the supporting schedules. So let me give you 5 minutes break just to ease up. Okay, let me make it 10. So let's resume at exactly 11:15 so that we can do the supporting schedules, and you'll see how we feed it back on the three statements, and you will see it balanced because we have the details. Thank you very much. We can take that short break for the interest of freshening up. I don't want us to be so bored on this. All right. All right. Oh, I mean, I was recording still.